Good morning and welcome to the Post-Monetary Policy Committee press conference. This is traditionally held by the Central Bank of Kenya the day after the Monetary Policy Committee meeting. In this case, this was held yesterday, Wednesday, the 27th of July, 2022. And today we'll have a press conference that is hosted by the Governor of the Central Bank of Kenya. As is customary, the Governor will go through his statement, and you're free to place questions which we shall be asked, shall be placed to the Governor after his statement. And you can do that through the Slido application. That's slido.com. The meeting ID is #MPC0722. So without further ado, we'd like to welcome the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Thank you. Good morning. A warm welcome to all of you who are joining us for this briefing following the MPC meeting. The MPC examined closely the recent economic developments, particularly against the backdrop of the past policy actions. And as before, we'll go through the various components of issues that came up. But at this moment, I presume you already saw the communique that was sent out at the end of the meeting last night, communicating high-level issues and also the final decision. So as we always do, we start with the global developments. And this continued progress in the fight against COVID-19. And I think there are two directions in this. One is vaccinations. And as you can see on the slide there has been significant improvement. I'm not going to go in detail through it. And then also, of course, the manufacturing of vaccines in our countries, outside of the tropics, as it were. And the second element, which I think was important here, was the world economic outlook. And here we recently had the IMF's global, let's say the IMF's view update, and this was actually on Tuesday, July 26th. And there are two elements that I wanted to flag in the IMF's view update. First is they characterized the world economic outlook as gloomy, and that's a very strong word, gloomy. In particular, global output contracted in Q2, in the second quarter of this year, and driven by downturns in some large countries, China in particular, Russia, and the U.S. was also underwhelming in its outcome. It was softer than was anticipated. A second element of this, of course, something that they said risks to the outlook are overwhelmingly tilted to the downside. That is also a word that is not in common usage in this sort of documents. And in particular, what was flagged was the war in Ukraine, potential for stoppage in gas imports from Russia, that is imports to Europe in general. Inflation could prove harder to contain in the advanced economies, and indeed spillovers from the monetary policy actions of the larger central banks, spillovers into the emerging market and developing countries. So all that, including the potential for a renewal or an upsurge of COVID, all those were risks that were flagged by the IMF in its view update and need therefore to be monitored closely. But in terms of the general numbers of global outlook, you have them there on the slide. You can see that the world economic the global growth has been scaled down to 3.2% in 2022. And so over the last 6 months, from January, they've actually cut back the projection for global growth in 2022 by 1.2 percentage points. That is significant. It's sort of significant scaling back of the outlook. US at 2.3, again, quite dramatic in terms of how much the total let's say, how much growth has been cut back. And China, 3.3. 3.3 growth for China. I think we have never seen numbers like this for China. I mean, China has been in the 10%, above 8, etc. I mean, Kenya growing at 5.4 is growing much faster, and indeed sub-Saharan Africa is growing faster than China. This is new territory that we have not yet traversed. Now, the others, but I think I want to leave them there. You have them, and they'll be circulated in the slide. I want to mention Kenya. The IMF, at least in their view update, had those numbers, 5.7. Of course, we are closer to the numbers, to the economy, and we had a different projection there. Projection is 5.4, I believe. And also, I would say that the 2021 number, so-called actual, that is actually not the actual. So they have to update their numbers, and this is something that obviously we expected to see in their numbers, and was somewhat disappointed was not in this specific update. But moving along, inflation dynamics in these countries, in the advanced economies, we already talked about this last time. The most urgent economic issue in the advanced economies, as we can see, is really inflation. And of course, there's the potential or impact of relations with Russia. I talked about, for instance, the gas imports, etc. But I think all that, in the first instance, have an impact on inflation. You can see the numbers there in terms of inflation of, let's say, in the euro area, at 8.6. This is territory they haven't been in. UK, 9.4, US, 9.1. This is significant, and indeed, the policymakers are very much seized with the objective of bringing down inflation and really ensuring that inflation doesn't get entrenched in those economies. As a matter of fact, as you know, yesterday the Fed, the U.S. Fed, did make its declaration at the end of the meeting, and in effect, this was inflation was front and center of what they said and their concerns. Then moving on to the crude oil prices, this is another important element in the international markets. And you can see that it has really gyrated quite a bit from the peak of back in February, March, I believe it was, of $130 per barrel. And this is our, let's say, our benchmark oil. And now it's around 100, well, actually on this chart it is 105, around the average for the year. The average for the year is 104.7. But actually, as of yesterday, it was $102.05 per barrel. So the expectation is, we do hope, I guess this is more a hope than an expectation. If there is any market that is really difficult to predict, it's the oil market. And the point is that we hope that let's say the policies of the advanced economies will lead to a significant decline of the international prices, and which will also be significant for ourselves in our economies. And now I'm talking of sort of the oil importing economies in Africa and elsewhere around the world. Moving along, of course, we also know about the other prices, global prices. And these, for some commodities, they are moderating and have been moderating since June. And we've just chosen some of the commodities here. And palm oil, for instance, that's the dark red more on the left-hand side. You can see that it peaked sometime in May, and that has actually been coming down. It came down in June and has continued to come down. The numbers that we have seen are much lower than this. But the others as well, the other commodities, wheat. Now, wheat obviously was significant also very recently because of that agreement between Ukraine and Russia, brokered by the United Nations and I believe Turkey, and really to allow the exports from those ports, the Ukrainian ports, of exports of wheat to the world, and thereby helping sort of avoid what would be a humanitarian crisis, food crisis in all our countries around the world. So that obviously will have significant impact. It's true there was a decline, and then there was a temporary increase as, you know, some, well, I guess, usual things related to anxieties, if you allow that word, you know, as to whether the agreement will hold, etc. But anyway, that notwithstanding, also transportation costs have been coming down, and clearly supply chain problems are moderating. And if you may, the supply chains are being repaired, which obviously will lead to lower global prices and of benefit to our consumers. But what are we struggling with as central banks? What is every central bank struggling with? I think a picture is worth 1,000 words, as they say. And here's a picture that that we got from the BIS. We've tweaked it a little, but it tells you more or less what the central banks are struggling with. Of course, there's the inflation issue. And then everybody understands inflation and growth. If we really stomp on the brakes, it's going to bring down growth. But the other elements, so you have, of course, the inflation at this stage is being pushed by supply shocks, which is what we talked about. And then on the other hand, our efficacy of our policies relate to this financial, the linkages between the financial sector and obviously the real sector. So how does, let's say, an increase in the signaling rate lead to real impact in the economy? And that is a balancing act. Obviously, there's a balance there. But at the same time, we have the other side of our mandate, which is more related to financial stability. And here you have asset prices and all the asset prices you may think of, obviously from the stock market, etc. But even from that perspective, the foreign exchange market, that's also another asset. And then it's balancing with debt. And if we sort of miss out on that delicate balance, it may come crashing down. So this, in a sense, in one picture, shows you what central banks around the world are struggling with. Of course, we are at different points. There are those that maybe the supply shocks were not that significant, or maybe there are those where the financial real linkages are very strong, or you may say that the others where the asset prices have grown significantly, for instance, in the advanced economies, and therefore, whatever the central bankers are doing in that area, there's a significant risk of what you may call sort of disorderly adjustment in those prices. So this is really what we are struggling with. It's not as simple as just looking at inflation versus growth. And I think that's, obviously there are things that can be changed, but I think that's a good picture. Critical balancing, the critical balance though requires precision, understanding the dynamics and data. Those are significant. So we now move to the domestic economy. And here, if you remember when we met 2 months ago, we warned of a clear and present danger of breaching our 7.5% threshold in the next 3 months. And indeed, in that context, inflation in June ended up at 7.9, precisely breaching it as we, in a sense, had warned before. Now, we didn't just warn, we warned, but we also acted. It was against that background that the MPC 2 months ago, took the decisive action of raising CBR by 50 basis points and raised that to 7.5%. Now, as for you have it there, you had seen that slide before, but I think we need to move quickly to the contributors of overall inflation. And you can see here most of the contribution, at least in June, was from food, was being driven by food. And if you looked at 4 specific food items in the CPI, wheat, maize, milk, and edible oil, you can see they contributed 2.9 percentage points in that 7.9 percentage points. So it is significant to see what is driving inflation as measured in our CPI. So moving on this, obviously at that point, that is, again, is that backdrop, the MPC had taken that decision. When we sat down yesterday, the MP assessed first that the impact of its policy action is still working through the economy. So as we had said, a change in the benchmark rate takes time to work through the economy. And yes, so that was assessed, and we looked at various data that it's still working through the economy. In a sense, trying to lower the inflation outcomes as measured. Secondly, the government did take measures to moderate the prices of specific commodities. And I think there's a long list of that, but maybe I can show it if we can quickly show it. I won't go through it in detail, but I think it would be good to just remind yourselves about some of this. First, of course, is the subsidies that have been there. Then there was the reduction in electricity tariff that has been in place for quite some time. There was the granting of waiver on the white maize imports, and that has been extended to the end of September. Fertilizer subsidy, and then more recently waiver of the various fees on imported maize. And then, of course, the one that there was a lot of discussion about was the subsidization of the price of unga, right? And this has been brought down to 100 shillings per packet, and this is the 2 kg packs. And of course, finally, the VAT lowered on LPG, that is our cooking gas, from 16 to 8%. All these obviously are acting on critical, you may say, components of, in the CPI, but I think also critical components in the consumer basket, as it were. So those were working through, as I explained. And then thirdly, international prices, as I mentioned a moment ago, were moderating or are moderating for key products. And I mentioned some of those, which I think one could follow where they are, say, over the last few weeks. A fourth element is that the food prices themselves, given the supply, or should we say where we are in the crop cycles of the various crops, there's expectation of increased supply, and this is corroborated by results we saw from our agricultural survey that I'll mention I'll talk about in a moment. So, taken together, the MPC decided to wait, or rather to maintain its current stance, as all these measures do their part or play a part in easing inflationary pressures in the medium term. So that's what I wanted to say about inflation, and at least in detail. Let's move on to the output. And here I think we already say that we'll get new data on Q1 GDP Q1 data. And And we can say that there has been very strong momentum in the first quarter, with the economy growing at 6.8%, as shown in the slide on the screen. Now, this was driven by non-agriculture, the non-agricultural sector, services and manufacturing. We need to make the point, and I continue making this point, that agriculture is somewhat of a puzzle. And the issue is, it's true, it's not as strong as maybe it used to be in the past, but I think the numbers still appear weaker than we were expecting. But be that as it may, we are working to understand whether it is a reporting issue or actually there is something else that's going on in this sector that we are not aware of. And that is one of the reasons why we started off on this agricultural survey, which I'll talk about in a moment. That notwithstanding, the leading indicators for Q2 point to continued good performance. Please move to the previous slide, please. Continued good performance, even against the uncertainties for the related to, let's say, the political calendar. And I think taken together and looking at various indicators, the economy is expected to remain resilient in 2022 at 5.4%. That is our current estimate. And I think, as I said before, 5.4 is a pretty solid growth in 2022. And that is, comparable, compared to other economies, given the shocks, external shocks that we are still navigating through, and also given our own internal shocks that we have to contend with. But now we talk about the specific sectors, and I'll go very quickly through this. First, of course, wholesale and retail. And this is going quite strongly, and that is the blue line up there. So you can see growing at 12 month, year on year, at 20%. That is quite strong. And of course, we know that this has a lot of, let's say, spillovers to other sectors. Then manufacturing, again, also quite strong. Looking again, this is sales turnover, and it is probably the earliest, the most, the most timely of indicators that we have, that we use for the sectors. Going to another indicator of manufacturing is power consumption, and this is the dark blue line, and you can see that the growth is around 5% last June. 8% in May, etc. Looking at the large power consumers, these are probably the industrialists, etc., the large industries, you can see that electricity consumption is growing steadily above, around 4%, 4-5%. Obviously in May it was much higher, but anyway, you can see that this collaborates that manufacturing is growing at a steady pace. Other indicators, consumption of cement, again, this is the blue line, growing at 19%. We are not sure why May was so low, but we are still digging at the data, because going from 20 to 1% is a bit surprising, but in any event, there's still growth, as you can see. And moving on to other transportation and storage, and indeed also the accommodation, etc. Again, very strong growth, 30%, almost 40%, and obviously for accommodation and food services, this obviously is growing very, very strongly. And maybe we could talk about that. I'm not sure if I have another slide on this. No? Okay, so, maybe we go through the credits. So credit growth, again, you can see that this shows very strong growth in all the sectors that we sample. But I think for this one, I wanted to mention consumer durables. And you can see it's growing quite strongly. This suggests that consumers are still very optimistic and still consuming the durables, whatever they are, you know. The overall credit growth is 12-month credit growth. You can see is at 12%, and this obviously is something that we haven't been in this territory for some time. And when I talk about banking, I'll talk about the credit risk, etc. We'll come back to that. But I wanted to say a few words before we go into the balance of payments. I wanted to say a few words about the hotel sector, tourism, etc. I note that the Cabinet Secretary of Tourism did make some very favorable comments or summary, and also his expectation of how the sector will perform. So how it is performing and will perform. And I think our information really collaborates on this. What is clear is that in June there was a significant pickup in foreign bookings. July is a pretty good month has been, and particularly for safari, let's say safari tourism, the Mara, etc., is already at 2019 levels. And in some instances, yeah, it's very hard to even get a place fully booked. You know, this is the time that we are having the migration, the wildebeest migration. But also other places, Amboseli, Savo, etc., all the other places, these are pretty much at 2019, that is pre-pandemic levels. And foreign booking also has remained solid for August. And there is indications that the second half will be very good. Now that is sort of on the hotel side, but you also have the conferencing side. And on the conferencing side, that also has worked very well. And we'll give you the numbers in a minute. But the general sense is that the conferencing has supported the hotels. And the conferencing, as you understand, a lot of it is local. But it's good that that has supported that sector. And now that the tourists are beginning to come back to more normal levels, I think we are pleased that the economy, or rather that particular economy sector, can begin to show the dynamism that we always expected of it. Moving to the specific elements of our MPC surveys, we had 4 surveys, and the first of this is the CEO survey. I only have one slide on this, but I want to say that the 4 surveys will be, we hope to have them published on our website by noon on Friday. So I guess that's tomorrow noon. But anyway, so you'll see the rest of it. But here I think the CEO surveys, you see CEOs here revealed their optimism, and they were being asked how optimistic are they, you know, for the next 12 months. And I think this chart shows significant dynamism in terms of their high level of optimism. The next slide is really on from the MPC Market Perception Survey. This has been around for quite some time. I don't want to speak too much to this because there's a particular slide I want us to look at. And this is on the banks. No. On the banks, you have 79% level of optimism, if you are the very optimistic and optimistic, okay? And so you could say those that are pessimistic or very pessimistic, 21% of the respondents. And then on the non-banks, that's the rest of the private sector, you can see the same level of, let's say, optimism, which is quite strong, you know, almost 80% right, on that. And you can see that at least for non-banks, this has increased since the last survey in May. So that shows continued optimism. But I think an even more interesting slide is the one that I'm now going to show, this one. So you can see on the left-hand side, what we have done is to compare the outcomes of the surveys. That is the one we did 5 years ago, just again before the elections, right? July of 2017. And compare that with July of 2022, the ones we did just a few weeks ago, which is the one I mentioned. And you can see the significant difference in optimism, level of optimism, for both banks and non-banks. So here you have, in 2017, the level of optimism was somewhere in the order of 26% for banks, right? And you could say 35% for non-banks. It's more than double that. I mean, we just now talked about 80% numbers. So this, in effect, shows with clear data how people are proceeding, making economic decisions. Last time, there was a lot of wait-and-see attitude in terms of decisions. Here, you can see why there isn't, you haven't had much of this wait-and-see attitude. The economy is still going on, despite what maybe some had thought would be problematic. So I really think this is a phenomenal sort of outcome, and indeed also data that is that we have come up with. Moving on, you can do other experiments. Of course, you have all the data on our website, so you can compare all surveys as you want. Then moving on to the hotel survey. The hotels, again, have been quite strong, as we mentioned. This I'll go quite quickly. So you can see the bed occupancy has been quite high, and we expect this to. So we are now past, let's say, the pre-COVID numbers, or COVID, before we were hit by COVID. And then the other numbers, in terms of conferencing, again, you can see the results indicate that we are at much higher levels, or at least you could say we are at pre-COVID levels. Forward booking, this is quite intriguing, I should say. If you remember in the past, forward booking would sort of plummet very quickly. So 1 month, 2 months, and then boom, it will go down dramatically. Actually, this is not the case here. And it is amazing because it just means that people are making decisions that are more long-term. And mind you, this is in the context of the political cycle, etc. So I think this is an amazing sort of, it shows you resilience in that sector in particular ways. I presume we should also say that the effort that has been put there to, let's say, market the destination, etc., has borne significant fruits. And we do understand that things don't just happen by themselves. There's a lot of blood, sweat, and tears behind any such results. Moving along, I want to go through them very quickly. And this is the first of our surveys of the agricultural sector. And we'll put the slides out in the pack, but I think the point here is that we did ask them about the expectation of commodity prices, and that is the outcome. We asked them about their expectations about supply, what is going to happen in each one of the products, and you can see what they said. Basically, there will be an increase in supply in some of those products, and they explain why. We also asked them about the factors that affect agricultural production, and this I think was kind of interesting, so I'll spend just a second on it. Transport costs, weather conditions, and input prices were the three most significant factors affecting agricultural activity, market supplies. And actually, upon thinking about it, we do understand why this would be. Anyway, all this and more will be in the final product when it's put out. Moving on now to balance of payments. And again, I'll try and go a bit quickly. Yeah, on exports, the overall increase, as we indicated in the press release, is something like 11%. So exports have grown in 12 months to June versus 12 months to June of last year by 12%. But I just wanted to flag a few commodities, tea, and we have another slide on tea. Do we have it? Yeah, here you can see tea in terms of our traditional partners. This has continued quite well. And I'm thinking particularly Pakistan and other, well, I presume Egypt, etc. Of course, again, it's this, you also understand that there are other suppliers that are having a tougher time producing their products, which has led to the price, to price and volume increases. No, please. Okay, so on other components, horticulture has not grown. Well, actually, there was a decline, and this is attributed to some issues in avocado exports, which we understand have subsequently been resolved. So we expect that avocado exports will grow strongly, and in a sense, a catching up effect, if one can see that in the data going forward. Manufacturers, that has also done quite well, grown by 22%. I think 2 months ago we did talk about manufacturer exports not doing well. I think maybe they have, now it's clear the numbers are getting stronger, but I think we do need to continue watching manufacturing because they should be one of the sectors that are really growing given the environment, given the exchange rate, etc. It should be manufacturing that really is driving exports and not just the traditional exporters. Moving on to other things, I think on imports, overall increase of 21%. That was also reported, but I think here the only ones to report is on oil. Oil, you can see the substantial increase, something like 82%. And on, if you break it into the various components, imports by broad categories, and in particular look at intermediate imports, excluding oil, it is growing by 20.9%. And that means the manufacturing sector should be, we just talked about the exports growing by around the same number, but it seems to me that there is some dynamism in that sector. Consumer imports also grown quite strongly, 13%. And this, I think, relates also to the item that we mentioned before in terms of credit growth to consumers. The others I'll go fairly quickly because, well, just to say that the services exports have done well, and tourism, this is also growing quite strongly. We talked about it when I was talking about hotels, but here are the numbers that collaborate. And then on diaspora remittances, this has continued to grow well. And I would sort of remind all of you that actually you do have strong seasonality with diaspora remittances. So it is not a monotonic growth through the year. We know it will begin to pick up again. And obviously, as we draw closer to, in the fourth quarter, it will pick up quite strongly, particularly when we get to Christmas. But again, we all understand the cycle that drives this seasonality. But that notwithstanding, there has been significant growth, as you can see in our numbers. Current account deficit, still we are projecting something like 5.9% of GDP. And year to June, we had 5.3. This is the deficit. And I think, as we have said before, it is fully financed by capital inflows, etc. So we don't have a problem with this number. Talking briefly about the currency, the shilling, in the context of the exchange rate, I think we'd begin, as we did last time, with the large, or let's say the major currencies. And you can see where they've been. I'm not going to go through them in detail. Only to flag the euro at 10, British pound at sterling pound at 11.6, and others. You can see them there. But the interesting one, I think, is the US dollar index. And this is an index that brings together or against major currencies. So against the US dollar. So you can see the US dollar has strengthened against the basket of major currencies by about 12%. And this is what is driving some of the dynamics that we see in the, let's say, major markets, the financial markets, and indeed our own, where we stand in our own foreign exchange markets. Coming closer home to Africa, these are the various currencies. And again, I'm not going to go through them in one by one, but suffices to say that we are at around 5%. This is January to July, the depreciation that we have seen, 5%. And you can see we're in the middle of the pack. So those sort of concerns of the currency depreciating significantly, I think they need to understand the dynamics that are going on against the US dollar, which is the US dollar is actually appreciating, popping quite strongly against most other currencies, and indeed also the Kenyan currency. But that also means that, we also have, this slide is showing the amount of foreign currency that we have, and the last number is 7.744 billion in US dollars, and appropriate or sufficient in terms of coverage of imports, etc. So shouldn't have a concern in that on that front. I wanted to make a few points on the domestic market for government securities has been well behaved. And I think you have the purple line there, which is the yield curve, which you can see is well behaved. At this point, I think we should also remind ourselves, for those of you that are involved in other economies, to appreciate that actually in other places, actually you do have a sort of inverted yield curve, which is kind of problematic, as you know. And there's a lot of discussion of that, but that is obviously not for this meeting. I wanted to say a few things about, now as we finish, with regard to fiscal performance. The MPC did look at the fiscal performance of our, at the end of the fiscal year, that is at the end of June. And indeed, it was a difficult year, but it yielded, let's say, record results. And first of this is in revenues, where revenues were much stronger than was even targeted. So in terms of ordinary revenues, they had something like 1.92 trillion Kenya shillings versus a budget of 1.85 trillion Kenya shillings. So that overperformance, I think, is something that we've never seen, definitely not in living memory. And I think the point here is we appreciate the work that was done by the revenue agencies, etc. I mean, the revenue collection agency, in this case, KRA, etc. Suffices to say that it gives us good prospects of achieving the deficit reduction that was expected or was planned for in the fiscal year 21-22. 2022. A couple of other things as we finish. The banking sector, I'll just say a few things about that, which is strong performance. It's true we did talk about credit risk remains elevated, and I think that is something that was reported in the press communique, including the increase in the ratio of NPL to gross loans at 14.7 at end June, up from 14.1 at end April. And we also explained that these were in manufacturing, agriculture, energy, water, transport and communication sectors, so specific sectors and specific accounts, so specific borrowers. And so they are not systemic in any way, but they relate to specific challenges, and there are various challenges, one of which is governance in some of those areas. And I think that is being worked out correctly. Banks have continued to make adequate provisions for these NPLs. By the way, we did have a credit officer survey, which we carried out at end June, and that will be published at I guess, shortly. And the credit, they show that, just two things to mention there. Credit risk appetite among banks is expected to remain the same. So so the credit standards also, will remain tight. And that, I think, is something that would offer us comfort, going forward. The other things I would mention, but I think two quick points here about some of the banks raising funds from the development financing institutions for SMEs and supporting their climate risk mitigation, lending, etc. Also, we continue to work with the digital credit providers, and as you know, we have recently been given the powers or and the mandate to regulate this sector, and we are working with them in terms of getting information from them, reviewing the information, and then moving on to licensing them before September 17, at which point, if you have people that are working or institutions that are working in this field and they have not received their licenses, then they'll have to cease and desist. There is the information about the IMF program, which I think you've all read and seen. Suffices to say that the review was done and completed without any questions. On the contrary, if you look at the press release and also the various things that have come out since then from the IMF, the performance of our program was very strong, exceptional performance in our program, and that was appreciated by the IMF board and indeed the IMF. I want to stop there. I know I have really overshot my mark, but I think there was a lot of information that we had to go through. And I think the bottom line is that the economy has strengthened quite well and showed a lot of resilience. And in terms of inflation, the MPC was quite clear why even as they are concerned, they took that step. And I think the issue here is to also continue to monitor the global risks that remain, as I mentioned before. So thank you very much. I'll take your questions.
Thank you. That was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge. And we go straight into the questions. We begin with Kefa Moirore from Radio Citizen. Kefa is asking, CBK held talks with banks and KEPSA on easing dollar access constraints. The challenge persists. Why is this a case, and what measures has CBK taken or is planning to take? Victoria Munga from the Voice of America is asking, are Kenyan banks experiencing a shortage of small notes? If so, why, and what is the impact? And finally, for this set is from Constant Munda from the Business Daily. What's the status in approval of banks to resume risk-based pricing of loans? How many banks have been approved?
Okay, so handling all those questions in a rather organized fashion. So I think I got it here. Thank you. So beginning with Kefa's question about what in the past was this dollar access constraints. I think this is an old story, Kefa. It's like 2 months old. And indeed, at this moment, as we explained, the specific, let's say, importers, those that were interested in getting dollars, have been working with their banks and understood that there were significant sort of shocks to our economy. And basically, in that context, there were greater demands. For instance, you could think about the purchases of oil, etc. We just talked about the price of oil and also therefore the revenue, or rather the cost, the value that would be going to buying those things. So I think the point I'm making here is that that was sort of like an old story. It has since been resolved, and as far as I know, the purchasers of dollars have been going to banks and working with the bankers. It's true, some of them were expecting to just go and get all their supply in one shot. And they're told, no, we do need you to sort of, we'll build it over time, you know. Now, if it is 2 million, that's not the significant thing. But if you're talking of an import bill of, let's say, 30 million or whatever, significant, that will need to be built over time. So I think, Kefa, that is an old story, and I don't think that is something that we are seeing at this moment. Now, it's true there are all sorts of other rumors about what people are doing with dollars, but those are rumors. And I obviously would not want to suggest that we are going to support rumors one way or the other, or go after rumors one way or the other. The question about small notes, I don't know, Vicky, I don't know about this question about shortage of small notes. I don't know where that story is coming from. All I can tell you is we supply notes as demanded by banks. For instance, in the month of July, we supplied the equivalent of banks demanded 2.1 billion of 100, the 100s. And we supplied exactly that amount, 2.1. So there was no, and we have a lot of stock of it. So I don't know where the story is coming from. But in terms of where we stand, when a bank demands, we provide. And it is our job to make sure that for the sake of the economy, you do have a constant supply as needed of legal tender. Of course, the point here is that it is for us to make sure that we do contact or are in touch with the banks, and also to be sure that we have enough stock, which I'm assuring you that we have more than enough stock in terms of, next question was on, if I may. So the next question was approval of banks. This has been going on, okay? I think to be honest, this story was overblown in the past about the risk-based pricing. And we have been working with the banks, going back and forth with them. And I think more than a half of banks have already had their let's say, their risk-based models approved, or should we say signed off with us. The others, we are at different levels of completeness. But again, we know that what we need to insist on is making sure that the models are realistic. They are not just some sort of a class project. And so we are specific about that. But I think the issues that were raised before were somewhat overblown. Was that the questions? Are those the questions, please?
That was the first batch of questions, Governor. The second batch begins with Duncan Miriri from Reuters. Duncan asks, what is behind the surge in business optimism in comparison to 5 years ago? Second question is from David Herbling from Bloomberg News. When does the CBK see inflation easing back into the target range? And the third one is from Constant Munda from the Business Daily again. The average interest on Treasury bills is at a 5-year high. What impact is this having on private sector credit growth?
Okay, so Duncan, I think here I can truly say kazi kwako. I think we all understand what I mean by that. I think it's an interesting question. I don't know the answer. I don't know the answer. What is behind? I mean, I have my hunch and sort of what I would say, I think what it would be, but that has to be tested. We haven't tested it, so I cannot tell you what it is. But I think therein lies something for you to check, and for others, other economists to check. I think it's an excellent question, Duncan, but I cannot at this moment tell you why. But we have concrete evidence, which I have shared with you, and go back, figure out what is different. You are with us 5 years ago, and ask people. I think it's an excellent question. I really do. When does CBK? This is David Elbrin. I would just say in the near term. In the near term. Does that mean this month or next month? It depends on how quickly those measures have effect. By the way, if we are talking of this month, the price of unga obviously was lowered to 100 shillings per 2 kilogram pack, right? The point is also that when KNBS went to survey the prices as they do, which will be reported tomorrow, not all, let's say, not all stores had already adjusted to the new price. So they actually, particularly at the beginning of the first half of the month, all those prices were at the old prices, the 210, 205s, etc. So I think the point I'm making is that only next month will we get the full benefit of the 100 subsidies on unga to bringing it down to 100, because by then all the stores will have brought their prices down to that level, and when the KNBS people then measure it, they'll see the new prices and not the old prices. So it's not enough to just say that the impact of unga should be X and then bring it into your equation, as it were. No, I think it takes time, as we can understand, and that's why we cannot be very precise whether it will be in July, numbers that we're going to see tomorrow, or should we say August or September. I mean, there are those dynamics that we need to monitor. Constant asks, T-bill rates. I don't know about private sector growth and T-bill, the T-bill rate. But to begin with, I think you should be, the Treasury bill rate hasn't, I mean, it's nowhere near where it was, let's say, 5 years ago, etc. If you want to compare things with 5 years ago or thereabouts. You remember the bad old days when was it? In 2022? No, 2015. 2015, November, December 2015, when it really shot up. I think it got to even to 20%. That is not the case. So I think that market has been working very well. As a matter of fact, there is nothing, well, we are very proud about how we've managed the securities market, also how we've managed the FX market. Those markets, and also the money market, those three markets, I'm very proud about how the central bank has managed them. And I think to make sure that there's order, etc. So I don't see this as a concern in terms of private sector credit growth. Why? Because the connection with it is one of, I mean, we talked about lending, right? Banks still have a lot of capacity to lend. And indeed, they can reduce their T-bill holding if they feel constrained in any way. But remember, T-bills are also useful for them in terms of liquidity management. So they will always hold some amount of treasury bills on their balance sheet. So I don't see the risk on credit growth. As a matter of fact, Constance, I thought you'd be happy about the credit growth that we are seeing now. We talked about 12.3%. That hasn't been something that we've seen in a long time. So there's no way that credit growth is being constrained by other factors.
The third batch of questions, we begin with Caroline Jenga from KBC. And Caroline Jenga from KBC has a question that is very closely related to one from Steve Biko from Soko Directory. So I'll ask both, but it's more or less the same question. So Caroline asks, how sustainable are the subsidies deployed by the government to address the high cost of living? Steve Biko's question is, how will CBK manage the inflation scenario if the fuel subsidy is removed come next month? Then the final question, I believe we may have asked this one, but let me just repeat it from Kostan Munda.
No, I did.
I think we answered that one. So those two questions.
Okay, so these two questions, Caroline and Steve, I think these are good questions. Sustainability of subsidies really depends on the fiscal space that is available. And as we all know, we have significant constraints on fiscal space. Why? Because there are some other urgent needs. I mean, we talk about development needs, building roads, building utilities, you know, also things about recurrent hospitals, you know, salaries. All those things are demands on the same tax revenues. So it's an expenditure that is for these subsidies, which has to be balanced against other expenditures. And that's why in the long run, it is not viable. It's not viable. Now, if you had a country, I don't know which country this would be, but that is not facing that significant constraint, meaning the subsidy element is not that large, and they can probably sustain it for longer. So, but in general terms, we are clear that this is not something that will be maintained into the medium term. So there is a sunset for these subsidies, and they are different across the various subsidy elements. The question is, what will happen then? And I think that's when we need to be at least be ready for that. You've talked about the fuel subsidies, but not just the fuel subsidies. We have the UNGA subsidies as well. And what I should also have flagged is that as the prices of fuel, international prices come down, then the need for subsidy will be lessened. So you can imagine if we are back in the $70 per barrel range, then for that reason, there wouldn't be any need for the subsidy, right? So I think the point here is that there are other factors that are also working through, which are exogenous, that are not driven by the policymakers or ourselves. They are being driven by other components. So think about then the the maize element. Sure, the price of hunger is now being subsidized at 100 shillings. But you also know that there will be importation. And this is in the context of a time when, say, there is not that much demand, not that much supply of the dry white maize. And it's been imported. I'm told that a lot of imports are coming from Zambia, and they have gotten appropriate approvals. And so once they land here, you'd expect the price of those components to come down. And I'm talking now in that context of even the price of unga. So there are those other elements that also need to be brought into consideration. So that is the long answer, but the point here is that all that needs to be looked at and in effect appreciate that this will not be there forever. The question is, will the subsidy be at the same level as they are today? Let's say where the price of oil in the international markets is very high. Then one would expect that, that component is also brought into the equation. I hope I've explained it sufficiently well to you, to both of you. I think those are the questions we had, or do we have a phone? Okay.
Just a couple more. One is from Bella Genga, which is very specific. Bella Genga is from Bloomberg News. Bella is asking, what kind of licenses do Flutterwave and Cheaper Cash have from the Central Bank of Kenya to operate their payments in Kenya? And a final one from Kefa Moirore, who is talking about the official reserves, which fell below the 4.5 months of import cover, with a near-term trend pointing to a continued erosion. How does the CBK plan to bolster this cover?
Okay. Maybe beginning with the second one, which is Bella's question. Flutterwave is not licensed to operate remittance provider, or for that matter, any of the, as a PSP, payment service provider in Kenya. So that is just, they are not licensed to operate, and therefore they shouldn't be operating. And Cheaper Cash, I think we could also say the same. So, specific answer. Kefa on official reserves. I don't know about this issue. I think we have to understand why the official reserves are where they are and whether they are adequate or not. Those are two separate questions. And I think it is true. We did not get the 1.1 billion in US dollars that the National Treasury had planned to borrow last fiscal year. And this was something that obviously was exogenous to us, you know. So, but we had expected that to come as part of our reserves. I'm sure there'll be a sort of a substitution of some kind, so that is not an issue. But I think in the interim, we use the reserves as we should, which is to make payments, external payments related to the government, debt, etc. So I think the point here is that we are planning when we have a build-up, we have let's say timelines on all those things, you know, stretching out 1 year. And during that period, we expect reserves to be adequate. You then ask about the 4.5 and 4.5 months of import cover. The point is there's no trigger, right? It's not like when you fall below 4.5, you know, it's like speed limit. If you're at 100, you are below the speed limit. If you're at 110, you are at the speed limit. And if you're at 115, you are above the speed limit. It doesn't work that way. I think we all understand that. But I think the point is that, as we indicate in our weekly, generally our number is 4 months of import cover. 4 months of import cover, we see that as, above that is very adequate, yeah? And when it is, say, below 4, then we'll be more concerned. But I think the 4.5 is not a trigger, and I think it's true. There is remember in the context of the EAC, they talk about expectation, which is not the same as a target, right? That you have to hit it. So I think that suffices as an answer, Kefa, to your question.
So thank you very much. That brings us neatly to the end of today's press conference. This was a press conference after the Monetary Policy Committee meeting for July. As we always do, we expect another Monetary Policy Committee meeting 2 months from now, that is September, and a press conference after that. But as it says in the press release, if there's any need to meet earlier, that will happen and will be told in good time. But for now, we thank you very much and good afternoon.